Good evening to all of you. We are again back to the basics chapter 2. You can see the title here, that is financial regulators. In this chapter we will be learning about what are the financial regulators which work in the market ecosystem. This photograph below is representing important regulatory bodies in India. For example, FSI, which regulates the food industry of India. SEBI regulates the security markets of India. The National Highway Authority of India regulates construction of roads and regulates the usage of roads also. While TRAI is the Telecom Regulatory Authority of India. RBI regulates the entire currency and other financial important decisions of India. And NABARD regulates the agriculture and agriculture related finances of India. So this is just a representation of what are important regulatory bodies in India. Now without much further ado, we'll go to the chapter proper. Before we go on to the chapter proper, let us do a recap of the key takeaways of the previous chapter, that is the need to invest. Now in part 1 of the previous chapter we saw what is the need to invest. We need to invest to secure our future for our post-retirement requirements, and we also need to offset inflation and other ever rising expenses. While in part 2 we saw the 4 asset classes of the world or of the financial world. These are real estate, gold, equity and fixed asset classes. In fact 99.99% of all your financial assets come in one of these 4 categories. Gold can also be substituted for the word commodity, but generally in commodities maximum of us buy gold, so I have written gold here purposely. Continuing with our key takeaways, in part 3 of the previous chapter we learned how to divide our wealth or investment in the 4 asset classes, which is also known as asset allocation. Now why asset allocation is done? Asset allocation is done to diversify your risk as per your risk to reward ratio, RRR. Each asset class has its peculiar characteristics with respect to risk and reward. The aim of all of us is to defeat inflation. So we diversify our risk by diversifying our investment in all the 4 asset classes, but on an offside we diversify our reward also. So with this we come to the introduction of today's chapter. Now what are markets? What is the market ecosystem? We'll be taking this important question in this chapter. Market is nothing but any place where you can buy and sell anything. Now how do we transact in the markets in our daily lives? We just give money and buy a certain thing. Now what are share markets or financial markets? Are they different from regular markets? That we'll see. And what are market participants? What are market participants? Who participates in the markets, and are there any intermediaries who help the market participants to transact? And who are the regulators, and what do we mean by regulators? There are regulators in all aspects of a civilized society. For example, police is a regulator, the judiciary is a regulator, the government is a regulator. So there needs to be a regulator in financial markets too. So who regulates the financial markets? That is the question. And why are they required? So these are all the questions which I hope you will be clear after the end of this chapter. So with this brief introduction we come to the aim of today's chapter, that is the aim of today's class is to understand financial regulators. For your ease of understanding, I have divided my class into 3 parts. In part 1 we'll be teaching you about financial markets. In part 2 we'll be teaching you about the market participants in the financial markets, and in part 3 we'll be teaching you about the regulators which are present in the financial markets. So let us take part 1 now, financial markets. Now in our normal day-to-day lives, what is a market? In this photograph I'm trying to represent a normal market which we come across in our daily lives. This is generally a vegetable market, to be specific, onions and potatoes markets. Now, how do we transact? What is a market in our daily lives? Market is a place where we buy or sell anything. Now, how do we buy and sell anything in the markets? We take our money cash, we give it to the shopkeeper. These are the shopkeepers. For example, this is you take your money, give it to the shopkeeper, and he gives you the equivalent amount of potatoes or onions or whatever commodity for which that market has been designed. Now, why are markets required? Markets are required because otherwise it will be a free for all. Everybody will install a shop anywhere. So there has to be a regulation where there is less crowding, where people can collectively come at a single point, where people can come in the sellers and buyers. The sellers and buyers both can come at a single point and transact, and where this transaction can be regulated and there are no defaults. Nobody tries to cheat anyone. So that is why markets are required. Basically, a single point place for transactions so that the transactions are regulated and a fair play system is created. So similar to a vegetables market or any other commodities market where we transact in cash, in the older times there used to be a actual trade ring where representative of brokers used to go. This is the Bombay Stock Exchange trade ring where representatives of stock brokers used to go and buy and sell actual physical shares. Remember, shares were earlier in the form of physical papers, that is share certificates. So this is the place where they used to bid and sell their shares and inside a ring. So this used to be known as a trade ring. You must have seen this scenario in the recent Netflix or online platform net series on stock markets. That is, to be precise, Harshad Mehta. So now let us take what is the financial market. This photograph is also an example of a trade ring. This is a Western market. This is not an Indian market, Indian trade ring. Western stock exchange, one of the Western countries' stock exchange. Okay. So now let us see the definition of financial markets. Financial markets are very much like a normal day-to-day market with certain changes, with certain differences. Let us see. It is a digital ecosystem which allows transaction of securities in a regularized manner. That is, which is also known as a secondary market. Now, what is the definition of transaction in a financial market? One transaction is equal to buy and sell in a pair. You buy 100 shares of Infosys, you sell 100 shares of Infosys. When you are buying 100 shares of Infosys, there is someone as a counterparty which is selling you those shares. So that is known as a transaction. Function. What is the function of financial markets? It facilitates the transactions and a common place where buyers meet sellers. The retailers can't access the primary market. Now, what is a primary market? Primary market is nothing but going and buying shares or stocks directly from the companies. For example, I turn up at Narayan Murthy's office and ask for 100 shares of Infosys from him. A hypothetical situation, he will not entertain me. However, that is known as a financial market. For example, however, if I go to Narayan Murthy's office and tell him I want 200 crores worth of Infosys shares, so in effect I am investing 200 crores in Infosys, then Narayan Murthy might be interested. There are investors who buy shares directly from the companies or the board of directors or the promoters, and then they have the option to sell it in the open markets also. Depends on the contract and certain conditions on which the promoter is selling them the shares. Now the retailers can't access the primary markets directly, that is directly buying from the company, most of the retailers, because obviously we don't have that much amount of money where the promoters of the companies will be interested. So to give an access to retailers, a digital marketplace has been created which are accessed through mobile applications, websites and sometimes phone calls also. The stockbrokers are there as an intermediary which are registered and which help you give access to exchange. For example, Zerodha, Sharekhan, Motilal Oswal, SBI Direct, ICICI Direct, there are certain examples of stockbrokers which help you buy and sell shares and other derivatives of companies from exchanges. Now there are two main exchanges in India, National Stock Exchange and Bombay Stock Exchange. There is a Pune Stock Exchange, Bangalore Stock Exchange, but they are slowly being phased out because most of the companies who are listed on India are now represented in NSE and BSE altogether. NSE has around 3000 companies while BSE has around 6000 companies. These are just ballpark figures. You can research them on the internet because these figures keep changing as and when new companies start getting listed. New companies keep on getting listed on both the exchanges. Now let us see, there are certain entities. Entities means people who are present in financial markets and who are affected or who are affecting the financial market. Now what is the who are the entities? So I already told you there are certain entities in financial market. Let us take this Venn diagram and see how they interact with each other. Now there is an entity known as financial intermediaries. To help a market ecosystem function, you require certain intermediaries between the buyers and sellers and between brokers and retailers. Okay, so they are known as financial intermediaries. Now because this is a financial market and emotions like greed and fear run high, so you require regulators to prevent malpractices. Regulators are entirely different from financial intermediaries, they don't overlap. However, finally there are market participants like us who participate in the financial markets. So we are also an entity. Financial intermediaries is an entity and regulators is also an entity. However, why I have overlapped these two, market participants and financial intermediaries, but there are certain market participants who do a dual role of financial intermediaries. For example, stockbrokers. Stockbroker is a financial intermediary. However, he sometimes acts as a market participant, sometimes acts as a counterparty to square off your position. That's why I have purposefully overlapped these two circles, that is market participants and financial intermediaries. There are also other financial intermediaries which can be overlapped. For example, banks, and there can be depository participants also who have a dual role of being acting as a market participant and acting as a financial intermediary also. So with this we come to the end of part 1. I hope if you have any questions you can put it on our WhatsApp group and I'll be glad to answer those. We come to the second part, that is financial market participants. Now I already told you who all of financial market participants. Anybody who buys and sells inside a capital market or a financial market is known as a financial market participant, or in short, market participant. So this is a photograph just as a representation of what exactly constitutes market participants. We are one of the entities in the market who form the market ecosystem. So market ecosystem is formed by all the entities along with the infrastructure. Now let us see financial market participants proper. What constitutes as participation and who are the participants? So definition: anyone who transacts in stock market is called as a market participant. Anybody who buys and sells shares, commodities, or any other financial security. I already told you what is a financial security as per the Security and Commodities Registration Act, or the previous chapter. So what is the financial security? So anybody who transacts in financial security is called a market participant. Market participants are classified into various categories. The classification depends upon the size of funds, the organizational structure, and the purpose of investments. The aim of all participants, however, is to generate profits, returns, or in short, make money. So now I'll be telling you all the categories of financial market participants in detail. With the help of this table, I've tried to summarize the information. So in serial number 1, let us see domestic retail participants. Now who are domestic retail participants? They are some people like us. We are individual level investors who have low size of funds. That is, generally it is taken as less than 2 crores. However, it is not a benchmark. These 2 crores might become 20 crores after around maybe 50 years. So today it is taken as 2 crores as a benchmark between low individual, that is domestic retail participants, and high net investors. Now we come to the second, that is high net investors. Who are high net individual investors? Basically people who invest more than 2 crores through the markets. They are wealthy persons in stock market. Example, Rakesh Jhunjhunwala and Ramakrishna Damani, R.K. Damani. Now, the third category is the NRIs and overseas citizens of India, the people of Indian origin who are based out of India. SEBI has, I have not, can't give you an example. However, SEBI has now instituted certain changes from 2019 on how and when NRIs can invest in India. They need to have a separate account, separate portfolio through banks to transact in Indian stock markets. Basically, it is a safety measure where it is taken as a safety measure where foreign companies should not use NRIs and overseas citizens of India as a backdoor entry to transact in Indian markets in high quantities. So it is just an additional surveillance measure which is used by making a portfolio system, a kind of a foreign portfolio. There is a term for that, you can search it on the internet, that how today NRIs can transact in India through a special account which is created in the banks. Now, domestic institutional investors, these are large corporate entities based in India, that is why they are known as domestic, who also transact in markets. The classic example would be Life Insurance Corporation of India. Yes, you might be surprised, but their LIC actually transacts in India. So there are domestic institutions who transact in share markets. Now, foreign institutional investors, the opposite of DII, that is not opposite exactly. This is domestic. These are same institutions but based in foreign lands. Non-Indian corporate entities and foreign asset management companies, hedge funds and other investors like Merrill Lynch, etc. Now the sixth category is the domestic asset management companies, AMC. These are nothing but mutual fund managers. You must have heard of mutual funds. The mutual funds are managed by a fund house. So they are known as asset management company. So example, SBI Mutual Fund, DSP BlackRock Mutual Fund, HDFC AMC, ICICI AMC is also an example. So these are certain categories of market participants which are present in the financial market ecosystem of India. So with this representative photograph, I would like to show you who all constitute as market participants. The government acts as a market participant, the central banks, central bank is RBI, banks, corporations, institutional traders, big high level traders, organizations who trade. Then there are retail traders. This is where we fit in, this is us. Then there is brokers, stock brokers, and then there is market makers, people who influence the markets. So this is what is a broad list of financial market participants. With this we come to the end of part 2. This is a small chapter and quite easy to understand. So with this we come to the end of part 2. Let us take part 3 now. So now in part 3 we'll be learning about financial regulators of India. So with this representative photograph, I am trying to tell you the regulator of banks and financial institutions. There are certain regulators in India which regulate banks and other financial institutions and also the market ecosystem. So the certain institutions like NABARD, which I have already told you, SIDBI, National Housing Bank, then there is PFRDA, IRDAI, then there is SEBI. So SEBI is the Securities and Exchange Board of India, which is the actual financial regulator in terms of exchanges or financial markets. Now before we come to financial regulators, we should a small slide on why regulators are required, or what is the need of regulators in any civilized society. Now aim of all participants in financial market is to make profitable transactions, that is to make money. So yeah, this is what sums up market part. You are there, you are doing this course because you want to make money, right? So that is why the aim of all market participants is to make money. Now human emotions in the form of greed and fear, run high in the monetary transactions. This is self-explanatory, I need not elaborate it further. You have seen the Netflix movie Harshad Mehta scam movie. So you know how greed and fear takes over whenever there is money involved in anything. So now with these two big emotions, unfair practices come up. I have already given you an example of Harshad Mehta, and in recent cases there was an incident of Hemant Ghai of CNBC Awaaz. He is an anchor, and I would like you to do homework on this. Okay, what was the Hemant Gai incident? This happened in the month of around February 2021, if I'm not mistaken, or maybe earlier. So this happened in 2021. What was the case? I would like you to do an on-time work or OTW on this. Now the stock market needs an entity to. What does it need an entity to? To set the rules, to ensure compliance, to maintain a level playing field, and protect the vulnerable. So in a normal civilized society also we need this. For example, we need someone to set the rules. The government and the judiciary, the government sets the rules. The police ensures the compliance. The judiciary ensure that there is a level playing field and the law, the justice prevails equally to everyone. And finally, the Indian government, along with all these agencies, they help in protecting the vulnerable. The same thing happens with SEBI. The SEBI or any regulator, they set the rules, they ensure compliance, maintain a level playing field, and protect the vulnerable. Now let us come to financial regulators proper. So similar to any regulator anywhere, an entity, financial regulators is an entity which sets in rules and ensures compliance. Now in Indian securities markets, the regulator is the SEBI, that is the Securities and Exchange Board of India. This organization was established on 12th of April 1992 under the SEBI Act of 1992. You can see this is just around the time 12 or some days after the Harshad Mehta scam took place. Now SEBI has a set of objectives and mandates which we'll be seeing in the subsequent slides. And if you want to go in detail about SEBI, you can visit this website. This is a hyperlink, or you can just copy and put it on your Google Chrome or on a web browser, and it will take you straight to the SEBI website. Now what are the objectives of SEBI? Let us see certain objectives of SEBI. The objectives of SEBI are development of exchanges. What the two main exchanges of India, Bombay Stock Exchange and National Stock Exchange, they need to develop. They have evolved over a period of time. Both of these have been running for many years now. So over a period of time they need to evolve. They need to keep abreast with the latest technology and latest requirements of people. So the development of exchanges is one of the main tasks or main objectives of SEBI. It sets and updates rules and regulation as and when new scams and new kind of default systems or new kind of cheating systems come into play. It also ensures compliance and regulates. And how does it ensure compliance? By regulating and by surveillance. It ensures fair and legal practices in the ecosystem. Basically, it ensures that nobody has a upper hand. Everybody has a level playing field. This is an idealistic view. However, at least we have an entity which tries to do it. It is not like Bitcoin where there is no regulator only. So on the left side, this is a good representation of SEBI. That is, it wants to balance compliances and penalties, and basically it's, this same symbol can be used for the Indian law also. But the law is blind and it has a measuring tool. So this is what this photograph summarizes the role of SEBI in the financial ecosystem of India. Now let us see, we've seen the objective, now let us see the detailed tasks of SEBI. The stock exchanges, that is BSE and NSE, the stockbrokers and sub-brokers conduct their business fairly and legally. This is what SEBI has to ensure in a nutshell. Now it also has to ensure that corporates don't use the markets to unduly benefit themselves. For example, Satyam Computers, again an OTW for you people. Please read it on Wikipedia or any other website. What was the Satyam Computers scam? It happened in 1990s somewhere or in the early 2000s. Large investors with huge cash piles should not manipulate the market. That is also one of the tasks of SEBI. This is why because anybody who has huge cash pile has the power to manipulate prices. So that is why SEBI has to ensure that these do not have an unfair advantage and start manipulating the prices, because in stock markets prices are dependent upon demand and supply. If someone starts buying unrealistically just to or illogically just to pump up the prices, then that is kind of an unfair practice for retailers. The SEBI's next task is to promote the overall development of stock exchanges, and it also wants to protect the interest of retail investors. Most of these tasks of SEBI are keeping the interest of retail investors in mind. Mind you, Indian stock market is growing like anything in last 2 years only. During the pandemic, Indian stock market grown by 200%. The number of demat accounts have grown by 200%. So SEBI has envisaged that Indian stock market will grow, the number of retailers will increase in India. At one time there were only 5 crore retailers in India or 4 crore retailers in India. Now there are around 7-8 crores retailers in India. Hardly some what percentage of, just around 5-6 percentage of the country is in stock market. So as and when more percentage of Indian people start investing in the financial markets, the role of SEBI to develop and protect the interest of retail investors becomes more important. And finally, SEBI has to regulate the activities of market participants and financial intermediaries. Now, certain rules have been set specifically for certain entities. I have told you there are three main types of entities: market participants, market intermediaries, and regulator. Regulators is SEBI itself. So basically SEBI sets rules for market participants and market intermediaries. Because for SEBI, the SEBI Act is the guidelines. So as per the objective, it is imperative for SEBI to regulate certain entities in the markets. A malpractice by any one of these entities will disrupt a harmonious market. Market is a harmonious ecosystem. So SEBI has a prescribed set of rules and regulations for each of these entities, as specific to each of these entities, and certain common rules also. Now the entity should operate within the legal framework as prescribed by SEBI. The specific rules are available on the SEBI website under the legal framework section. So this is where I have given you the SEBI regulations hyperlink, where you can just click on this and go to the legal framework section, where guidelines for different entities have been enumerated by the SEBI website. Now, similar to the previous photograph, this photograph also tries to tell that SEBI is now regulating all these market entities. So these are a set of market entities, and now SEBI, in this photograph represents that SEBI is trying to regulate all these market entities by having specific set of rules for each one of them and a common set of rules for everyone. Now this is just theoretical. You can just pause whenever you want and you can read it. The entities like credit rating agencies like CRISIL and ICRA, they have what do they do? They rate the credit worthiness of government, and in simpler words, SEBI tries to control them so that they don't give an unfair rating to anyone. So if a corporate or government entity wants to avail loan, basically credit rating agency checks if the entity is worth of giving a loan. So SEBI, it comes on the radar of SEBI. Then there is debenture trustees. But debenture trustees are nothing but they act as trustee to corporate debenture. Whenever a company wants to raise a loan, they can issue a debenture or a bond against which they promise to pay an interest. Basically, they take loan directly from people. These debentures can be subscribed by the public. However, you require someone in between who can act as a debenture trustee and issue these bonds. Then there's depositories, NSDL and CDSL. They are basically the demat account maintainers of India, the only two organizations which maintain demat accounts. Then there is depository participant. You cannot open a demat account directly, though you require someone in between to help you open a demat account. So most of the banks and few stockbrokers are now depository participant. And foreign institutional investors, foreign corporate funds and individuals. So these are the entities for which SEBI has made certain rules. You can read it. It is self-explanatory. Any questions with respect to them, you can ask me. We continue with the entities control. I'll just enumerate the merchant bankers. Merchant bankers are nothing but companies who help corporates in doing business in the financial markets, like IPO, offer for sale. Basically, they provide advisory services to corporates. Now, asset management companies, these are fund houses who run mutual funds. SEBI has certain rules for them also. Portfolio managers. Why SEBI has certain rules for AMCs? Because they have huge cash piles. So they are the ones who influence the prices. Portfolio managers and portfolio management system, they are something like mutual fund managers. However, they are like custom. They give you customized services. If you have more than 25-30 crore rupees, then instead of going to a mutual fund, go to a portfolio manager who will help you manage your portfolio in detail. And stockbroker and subbroker, they are self-recognized. Zerodha, Sharekhan, ICICI, Direct, etc. examples of stockbrokers, and they act as intermediary between an investor, that is retailer, or any other investor in the stock exchange. So you can read this slide also after pausing, and you can read it in detail. Any questions, I will be happy to answer you in the WhatsApp group. Now with this we come to the end of part 3, and finally we come to the end of this particular chapter only. And this chapter has been small. Subsequently the length of the chapters will increase. So with this we come to the end of part 3, and we'll take a brief overview of the entire chapter now, that is key takeaways. I want you to take certain important aspects of this chapter. So these are, in part 1 we learned about financial markets. Financial market is a place to transact in financial securities. Financial markets exist digitally and can be accessed through a broker in form of web or mobile application, also through calls. A financial entity, what are financial entities? Market participants plus intermediaries plus regulator plus the infrastructure give you a market ecosystem. So these three, participants, intermediary, regulators, are financial entities. In part 2 we saw financial market participants. There are different categories of financial market participants. Anybody who buys and sells, you are one of the market participants. The aim of all market participants is to make money, and emotions of greed and fear run high in all the market participants when money is involved. So because of these emotions you require a financial regulator. Because of these emotions you require a financial regulator. So SEBI is the financial market regulator of India, which ensures there is no malpractices and ensures a level playing field. It sets rules and ensures compliance, and there are different entities for which SEBI has a different set of rules. But there are certain common rules also which everyone has to follow. Now SEBI constantly conducts surveillance and intervenes if required. I already gave you an OTW of Hemant Gai, the anchor or ex-anchor of CNBC Awas. So I want you to do a homework on that, and also the Satyam Computers scam. So with this we come to the fag end of this chapter. Any questions, I'll be happy to answer you on the WhatsApp group, or you can put your questions in the YouTube comment section also. So with this we just come to the conclusion that there are certain entities which work in the markets, financial markets, and financial markets is a place where emotions run high of greed and fear. So whenever there is emotions of greed and fear, there is a chance of malpractice. So we need to have an entity in financial markets to ensure that there is no malpractice and small retail investors are saved, and the vulnerable investors are saved, and big investors do not manipulate the markets. The same like any civilized society, we require a regulator like judiciary and police, and a government to help the vulnerable, to protect the vulnerable. Similarly, we require the services of SEBI to protect the vulnerable in financial markets.